You're about to lose money, and you won't even see it happening. Not because of a crash tomorrow morning, not because of one scary headline, but because of something much slower, something quieter, something Ray Dalio has been warning about for years. And if you ignore it, it doesn't just hurt your portfolio, it changes your future. Right now, most investors feel safe. Markets are moving. The system looks stable. Retirement accounts look fine. But history shows that the biggest wealth destructions don't begin with panic. They begin with comfort. If you care about protecting your money, your freedom, and your long-term future, stay with me. Because what we're about to break down could change how you see the next 10 years. And before we go deeper, if you value clear, calm macro thinking without hype, make sure you like this video and subscribe to Think Like Dalio. This channel is built for people who want to understand the system, not react emotionally to it. Now let's get into it. Be radically transparent. That simple principle from Ray Dalio is not just about business culture. It's about survival in a fragile financial system. Radical transparency means looking at reality as it is, not as we wish it to be. It means facing uncomfortable truths early, instead of paying a higher price later. So let's be radically transparent about where we are. The global economy is carrying more debt than at almost any time in modern history. Governments are borrowing heavily. Corporations are rolling over massive loans. Consumers are using credit to maintain lifestyles that income alone cannot support. For years, this didn't feel dangerous because interest rates were extremely low. Cheap money made everything look manageable. But debt doesn't disappear. It compounds. Ray Dalio, founder of Bridgewater Associates and one of the most respected macro investors in the world, has spent decades studying long-term debt cycles. He didn't just look at the last 20 years. He studied centuries, empires, reserve currencies, financial crises, social unrest, and he noticed a repeating pattern. First, debt is low and growth is strong. Then credit expands, asset prices rise, confidence builds, borrowing becomes normal, leverage increases. Then eventually debt grows faster than income. At that point, the system becomes fragile. The fragile stage doesn't look dramatic at first. Markets may still rise, unemployment may stay low, politicians may sound optimistic, but under the surface, something shifts. The economy becomes dependent on continued borrowing. If credit slows, growth slows. If rates rise, pressure increases. After 2008, central banks cut rates close to zero. They printed money on a massive scale. This prevented collapse. It also pushed asset prices higher. Stocks, real estate, bonds, almost everything benefited from easy liquidity. Then came another shock, more stimulus, more money creation, more debt. For a while, it seemed like printing money could fix everything. But when inflation surged, central banks had to raise rates quickly. And that's when the real test began. Higher rates mean higher borrowing costs. Governments now spend more just to pay interest. Corporations face refinancing risk. Homeowners feel pressure. The entire system becomes sensitive. Radical transparency means asking a simple question. If debt is extremely high and interest rates are no longer near zero, how sustainable is the system long term? Dalio explains that when debt levels reach extremes, policymakers have limited options. They can reduce spending, they can raise taxes, they can restructure debt, or they can print money and devalue the currency. None of these are painless. Most governments choose a mix. Historically, devaluation becomes attractive because it spreads pain quietly. Instead of openly defaulting, governments allow inflation to reduce the real value of debt. If you owe $100 and inflation reduces purchasing power, that 100 becomes easier to repay in real terms. Preparation doesn't mean fear, it means clarity. It means understanding what is within your control and what isn't. For example, you cannot prevent a government's fiscal decisions, but you can diversify your investments, maintain liquidity, and plan for different economic scenarios. You cannot control political polarization, but you can adjust your exposure to sectors or regions that are less sensitive to policy swings. You cannot stop rising global competition, but you can understand which industries or markets benefit from these shifts and which are most at risk. But for savers, This is dangerous. Cash loses value. Fixed income loses purchasing power. Even wages may not keep up. Now add another layer. Dalio doesn't only study debt. He studies internal conflict and external conflict. Internally, wealth gaps widen during long debt expansions. Those who own assets benefit. Those who depend on wages struggle with rising costs. Political division increases. Trust in institutions declines. Externally, rising powers challenge established ones. Trade tensions grow. Sanctions become tools. Capital flows become strategic weapons. We've already seen examples of reserves being frozen, supply chains being restructured, countries looking for alternatives to existing financial systems. This is what Dalio calls a changing world order. It doesn't mean collapse tomorrow. It means transition, and transitions are volatile. Most investors are trained by the last decade. Buy the dip. Expect central banks to step in. Assume liquidity will return quickly. That worked in a world of low inflation and falling interest rates. But what if the environment changes? What if inflation remains structurally higher? What if governments must choose between controlling prices and supporting markets? What if geopolitical fragmentation increases uncertainty? Radical transparency requires admitting that the future may not look like the recent past. Let's slow this down and make it practical. Imagine you are building wealth for retirement. For 15 years, asset prices mostly rose. Even during corrections, stimulus came fast. But in a late-stage debt cycle, volatility increases. Markets may swing wider. Policy responses may be slower or more complicated. Inflation may erode real returns even if nominal numbers look stable. This means your strategy must adapt. Dalio often talks about balance. Not extreme predictions, not panic selling, but diversification across assets that behave differently in different environments. Growth assets, defensive assets, real assets, geographic diversification. The idea is simple. Don't depend on one outcome, because in late cycles, outcomes spread wider. You may see strong rallies followed by sharp declines. You may see inflation spikes followed by slowdowns. You may see policy shifts that surprise markets. If you are emotionally reactive, you lose. If you are structurally prepared, you survive and even benefit. Now let's talk psychology. The hardest thing for investors is not data, it's ego. We want to believe our country will remain dominant. We want to believe our currency is safe forever. We want to believe policymakers are fully in control. But history shows that no empire stays on top permanently. No reserve currency lasts forever. These transitions take decades, not days. They begin quietly. Radical transparency means studying history without arrogance. In the past, when debt became excessive, countries experienced either deflationary collapses or inflationary resets, sometimes both. Asset prices adjusted, currency values shifted, political structures changed. Dalio's messages, not fear, it is awareness. If you understand this cycle, volatility becomes less shocking. You stop asking, why is this happening, and start asking, where are we in the pattern? On Think Like Dalio, our goal is not to predict exact dates. It is to understand structures. When you understand structure, you make calmer decisions. You reduce emotional trading. You focus on resilience. Government debt servicing costs are rising. Demographics in many developed countries show aging populations. Productivity growth must accelerate to offset debt burdens. Geopolitical competition remains elevated. Technology is transforming industries faster than regulation can adapt. None of this guarantees disaster, but it increases complexity. Complex systems are fragile when overstretched, and debt is a form of stretch. If confidence remains high, the system continues. If confidence cracks, capital moves quickly. Bond yields can rise sharply. Currencies can weaken. Markets can reprice risk fast. The question is not whether volatility will appear. It is whether you are positioned to handle it. Radical transparency also applies personally. Are you overleveraged? Are you relying on one income stream? Are you fully exposed to one asset class? Are you emotionally prepared? for a 30% drawdown without panic? These are uncomfortable questions, but asking them early is cheaper than answering them during crisis. There is another side to this story. Late-stage cycles also create opportunity when assets reprice. Long-term investors can accumulate quality at better valuations. When fear rises, disciplined capital gains advantage. When weak structures break, stronger ones emerge, but only if you survive the transition. Dalio built Bridgewater by studying cause and effect. When something worked, he asked why. When something failed, he asked why. He wrote down principles so mistakes would not repeat. Be radically transparent means don't hide from reality. Not in business, not in investing, not in personal finance. If inflation is eating purchasing power, acknowledge it. If debt levels are unsustainable long term, acknowledge it. If geopolitical risk is rising, acknowledge it. Clarity reduces fear. When you see the system clearly, you stop reacting to every headline. You understand that cycles move slowly. Then suddenly, you focus on positioning rather than predicting. And here's something most people miss. Transitions do not destroy everyone. They redistribute advantage. Those who adapt early often strengthen their position. Those who deny change often fall behind. So how do you think like Dalio in this environment? First, study history. Understand long-term debt cycles. Understand how past empires rose and declined. Patterns matter more than daily news. Second, diversify intelligently, not randomly, intentionally across environments. Third, control leverage. High debt magnifies risk during tightening phases. Fourth, maintain liquidity. Opportunities appear during stress, but only for those who have flexibility. Fifth, manage emotions. Fear and greed are amplified in late cycles. And finally, stay radically transparent with yourself. If your strategy only works in one perfect scenario, it is fragile. The next decade may reward patience more than speculation. It may reward balance more than concentration. It may reward humility more than confidence. As we close, I want you to reflect on something. What worries you most right now? Inflation, government debt, political division, global power shifts? Put it in the comments. Let's build a real discussion. Your perspective matters. If this breakdown gave you clarity, share this video with someone who needs a calmer, smarter view of the macro landscape. And if you haven't already, subscribe to Think Like Dalio so you don't miss the next deep dive. Because cycles will continue, markets will move, headlines will shout, but those who see the structure beneath the noise move differently. And that difference, over time, becomes wealth.